Somewhere between a deal that nobody has signed, a currency design that has no legal authority, and an IPO roadshow that starts in 5 days, 3 stories this week have quietly moved from alarming to something closer to instructive. They each show you a different version of the same move. Announce something with maximum confidence, manufacture the appearance of momentum, and collect the benefit before the underlying reality catches up. Let's go. This morning, the Iran deal is still unsigned by either side. U.S. officials confirmed to AP, CNN, and PBS on Thursday that a tentative memorandum of understanding had been reached between American and Iranian negotiators in Doha. The framework would reopen the Strait of Hormuz to unrestricted navigation, remove Iranian mines from the waterway within 30 days, proportionally lift the U.S. naval blockade, and grant Iran sanctions waivers to resume selling oil. In return, Iran would commit, verbally, not through verified dismantlement, to not pursuing nuclear weapons. A 60-day negotiation period on the actual nuclear program would then begin. Neither Trump nor Iran's Supreme Leader Ayatollah Mojtaba Khamenei has approved this framework. Vice President Vance said on Thursday it was still TBD whether Trump would sign. One senior U.S. official told reporters plainly that a deal would not be signed on Sunday because the Iranian system does not move fast enough. Iran's semi-official Tasnim news agency, which is affiliated with the IRGC, said the deal could still be canceled because the U.S. was obstructing clauses related to the release of Iran's frozen assets. Al Jazeera confirmed that Iran told all mediators, including Pakistan, that it will not sign unless all clauses are fully agreed and guaranteed. So what we have is a framework that both principals have declined to ratify, in which the central demand that started the war, the verified disposal of Iran's 440 kilograms of enriched uranium, has been reduced from an immediate condition to a discussion topic for 60 days from now. And yet, the energy market has already priced the deal as if it's done. Gas prices at the national average fell by nearly 14 cents in a single week, the largest one-week drop since November 2008, during the depth of the global financial crisis, according to AAA data cited by CNN. Oil futures dropped sharply Thursday morning on deal optimism, then rebounded later in the day when new fighting in the region reminded traders the ceasefire was still being violated from both sides. Markets are moving on press releases, not signatures, not verified mine removal, not inspections. On the language of anonymous officials speaking on condition of anonymity about a document that hasn't been signed. I want to be direct about something. The SpaceX IPO roadshow begins June 4th. The listing is June 12th. A resolved Iran conflict, or even a credible-looking one, would drop oil prices, ease inflation pressure, boost consumer sentiment, and send equity markets into a fresh, record-breaking run. That market environment would be, by any measure, the optimal backdrop for pricing history's largest IPO at a $1.75 trillion valuation. I'm not saying the two are coordinated. I'm saying that everyone in the room can see what a signed deal would do to market conditions, and that the gap between announced and actual has been generating the market-moving impact of a real deal for 2 weeks now without producing one. Whoever benefits from that gap is worth noticing. Now let's talk about the $250 bill, because what happened at yesterday's White House press briefing should have generated more alarm than it did. Treasury Secretary Scott Bessent walked into the briefing room and displayed a mock-up design for a $250 bill featuring President Donald Trump's portrait and signature. He told reporters that the design was ready, that the Treasury had created the bill, and that the rest was up to Congress. Here is what federal law currently says. Since 1866, for 160 years, the United States government has explicitly prohibited living people from appearing on U.S. currency. That law exists for a reason that the framers didn't need to articulate in detail because they assumed it was obvious. Putting a living leader's face on the nation's money is what monarchies do. It is how you encode political power into the physical object that every citizen handles every day. It is how you make one person's face synonymous with the nation's wealth and authority. The United States ended that practice in the 19th century on purpose. The legislation to change this, H.R. 1761, the Donald J. Trump $250 Bill Act, introduced by Representative Joe Wilson of South Carolina, has not passed. It has not passed the House. It has not passed the Senate. It has not been signed into law. Current law still bars this design from being printed. And yet the Treasury Secretary of the United States stood at a White House podium and displayed the completed design, describing the exercise as responsible preparation. Bessent said, "We have to be prepared." That framing is worth examining. You are not prepared for a law that doesn't exist. You are exerting public pressure to normalize the idea that it should. By displaying the design in the White House briefing room, with its photography, its press pool, its guaranteed distribution across every outlet, the Treasury has manufactured a visual reality before a legal one. Americans will see the bill. They will process it as a thing that exists. The formal step of legislating it into existence becomes a matter of paperwork, catching up to an image they've already absorbed. This is not isolated. Trump's signature is already appearing on all newly printed U.S. currency, a first for any sitting president. Trump's portrait appeared on a banner over the Justice Department building in Washington. His name was added to the Kennedy Center for the Performing Arts. His face is on the America the Beautiful National Parks Pass. Commemorative limited edition passports feature his portrait and signature. The State Department announced those in April. A $250 bill with his face has now been shown at a White House press briefing, as if legislation were a formality. Time magazine noted that critics say this pattern elevates Trump to the status of a monarch. That criticism is understated. Monarchs put their faces on things because sovereignty is personal to them, because the state and the person are legally indistinguishable. The United States Constitution was written specifically to prevent that conflation. The prohibition on living people appearing on currency isn't an administrative quirk from 1866 that we've simply never updated. It is a deliberate structural choice about what kind of political system this country is. Displaying a design that violates that choice before the law changes is not preparation. It's a statement about who decides. And now SpaceX. 13 days. The roadshow starts June 4th. Pricing is June 11th. The Nasdaq listing is June 12th under ticker SPCX. Goldman Sachs is leading a 21-bank underwriting syndicate. The target valuation is $1.75 trillion. The target capital raise is $75 billion, triple Saudi Aramco's 2019 record. At that valuation, SPCX would price at approximately 94 times trailing 2025 revenue of $18.67 billion. Even on optimistic 2026 forward estimates of $27 to $30 billion in revenue, you're paying 58 to 65 times sales. The company posted a net loss of $4.9 billion in 2025 and $4.27 billion in Q1 2026 alone. Free cash flow remains negative. The XAI division, acquired in February through a merger that Musk controlled entirely, consumed $7 billion in capital spending in 2025 without producing the revenue growth of its competitors at OpenAI and Anthropic. Now here is the specific risk that is being underreported across almost every outlet covering this listing. SpaceX carries zero key person life insurance on Elon Musk. SpaceX's own S-1 registration statement discloses that Musk is the driving force behind our growth, innovation, and operational success, and that his loss, whether through death, disability, or simply unwillingness to continue, could significantly disrupt our management structure. You cannot replace him without approval from Class B shareholders, whose supervoting shares give Musk 85.1% of voting control. He cannot be removed, and the company has chosen not to insure against his absence. Think about what you are buying at $1.75 trillion. You are buying a company whose value is explicitly tied to one specific person, whose governance structure ensures that person cannot be accountably managed or replaced, where that person is simultaneously running Tesla, Neuralink, The Boring Company, XAI, and serving as senior advisor to the President of the United States, and where the company has decided not to take out an insurance policy on the event that would most directly and immediately destroy the investment thesis. The float is 3 to 4% of total shares outstanding, That number is not a coincidence. With a compressed float, you don't need enormous organic demand to push the price higher on day one. And Nasdaq changed its index inclusion rules on May 1st, just 6 weeks before this listing, to allow companies ranking in the top 40 of the Nasdaq 100 by market cap to qualify for inclusion after just 15 trading days. SpaceX at $1.75 trillion would almost certainly qualify. That means index funds, which manage trillions in passive money and are legally required to track the index, would be forced to buy SPCX approximately by July 7th, regardless of their analysts' view of the valuation. The float is tight. The forced buyers are structured in the retail access through Schwab, Fidelity, Robinhood, and SoFi puts everyday investors in position to provide the marginal demand that bridges the gap. The Motley Fool said directly this week that retail investors would be wise to keep their distance and treat this as a potential trap. Identified the key person insurance gap as the single most alarming undisclosed risk. Private investors who got in when SpaceX was valued at $350 billion in late 2025 are selling at $1.75 trillion, a 5x return in under 6 months. June 12th is the day those people get their liquidity. The people on Robinhood submitting IOIs this weekend are the ones providing it. This is not an argument that SpaceX is a bad company. Starlink is real. The launch monopoly is real. Starship has genuine long-term transformative potential. 75 trillion valuation on a cash-burning company with no path to profitability. A single uninsured, irreplaceable individual at the center of the entire thesis. And a governance structure that gives public shareholders zero ability to hold that individual accountable. That is not a question of whether the technology works. It is a question of who absorbs the risk if it doesn't. And the answer, by June 12th, is retail, a peace deal that moves oil markets without being signed, a currency design displayed in public without a law to authorize it, and an IPO structured so that the people who made 5 times their money are getting out at the same moment the people on Robinhood are getting in. The thread is the same one this week has been building toward. In each of these stories, the benefit precedes the event. The market prices the Iran deal before it exists. The currency design normalizes before the law changes. The IPO liquidity extracts before the business produces earnings. The people absorbing the downside if the event doesn't materialize are not the people who announced it. That asymmetry is the story. That's what this week has been about.